Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, September 27th, 2022. I'm your host, Will Pauly, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
We had another pretty crappy week last week. Again, second in a row. I think we're now down for the fifth week out of six. Last week we had the Dow Jones join the Dow Jones Transportation Index at the new low for the year. And then actually yesterday we had the S&P 500 make a new low for the year. Closing low I'm talking about. I think today it may have made it another low. I'm not sure. But anyway, started out last week with a quick bounce. We had the September FOMC meeting coming up on Wednesday. We were expecting a 3/4 point hike, which we got. But the Federal Reserve kind of rattled the market a little bit by saying that they were looking for another 1.25% in hikes by the year's end. So that means that we're probably looking at another half at the November, and possibly a quarter or another half maybe December. So I think a lot of investors are still hoping that the Fed's going to pivot here, but I think that's kind of wishful thinking, and I'm hoping it's something you want to invest on. So anyway, with the rates going up, we saw the U.S. dollar again marched a little bit higher. I think it was the highest now we've been since March of 2002. That's weighing on commodities, which in a way, since commodities are priced in dollars, is actually helping to fight inflation a little bit by strengthening. As you're going to start to see, I think it takes a while to work into the system, but you're going to start to see, some of these prices, lumber and wheat, that type of thing, start to come down in price, which will help the inflation data later on. Also, usually will weigh on crude oil prices also. And we saw oil prices slip below $80 a barrel on Friday for the first time since January. And I think yesterday we actually got down to about $76 a barrel, which is also the low we probably saw in January. So we're getting some pressures on especially commodities that are going to bring it's going to weigh on inflation going forward. We'll see how it goes. That loss in oil and gas last week left the energy sector down more than 9% on the week. I mean, that's a big fall for a 5-day period. We also saw losses in a lot of the growth sectors like consumer discretionary, communication services, materials, financials. And you're wondering what financials, usually a lot of people will think that they will outperform as rates go up, but in this case, where the short range is going up so fast that the yield curve is widening, which is not good for the banks, and that's why you're seeing the sell-off. Plus the fact that with rates going up this fast, you're pretty much, if we're not already in a recession, you're pretty much ringing the bell. The recession is coming, which will immediately start to weigh on the number of loans going out. Also, besides just the number of loans going out, you're going to start to see more delinquent loans coming out. In fact, I think I heard somewhere this morning something like new mortgage payments. There's something like 20% have already had some late payments because of the yields moving up and stuff like that. So that's why the banks aren't performing this. I think at some point here, if we can start to see maybe a little bit of a tick lower, where the yield curve will narrow and not be inverted, the banks will be a place where we're going to want to put some money. But we'll talk about that later on. But anyway, those sectors that I had mentioned, the kind of growth sectors, they were all down more than 5%. We are seeing some action in the defensive sectors. And by defensive sectors, I'm talking about normally it would be like utilities and REITs. But the last day or two, healthcare would also be considered a defensive sector, which I think is okay. Energy sector, you can still nibble away at that. But as far as the interest-sensitive utilities that normally would be, if we're going to recession, would be places you want to be. We're not seeing, because rates are going up so high, you're seeing some people selling some of the REITs and also some of the utilities now. The REITs also, you're seeing a big disparity in office spaces, things like that. And then with rents going up even higher and yields and the mortgage rates and stuff going up higher, that's also slowing down some of the REITs that have had a pretty good year up to recently. So anyway, so we put it all together. We had a lot of areas that were weak. Even the housing stocks got hit with the mortgage rates. They were up around over 6, maybe 6.5% last week, down 5 out of 6 weeks. The technical condition of the market, as I said, deteriorated. We're seeing the major averages, trading sharply lower. They're breaking at June lows. Today, we saw the Dow, I think, was up about 350 points at the open. Last I looked, we were down about 275. Part of the reasons, there's 2 reasons for the sell-off currently. Number one, you're having a lot of, usually at the week after you have the FOMC meeting, all the Fed presidents come out and they kind of give their 2 cents worth, and they're all being fairly hawkish. I think yesterday, who was it? I don't have it in front of me right now. One of them came out and said that, hey, don't, it was Atlanta Fed President Bostic. He said, don't think that we're not, going to attack these rates to fight inflation. We're going to make sure that the market knows what we're trying to do. And today you also had, I think, Fed President Bullard. I think he's from Chicago Fed. He said to get inflation under control. He says we got room to go without causing a recession. But he says we're going to keep raising rates higher because we don't think we're going to throw everything into a recession quite yet. And the market hears that. It doesn't want. It's a little bit more hawkish than what investors want to hear. And then today we also had some better than expected economic data came out. Durable goods orders, they eased 0.2%. Analysts were looking for them to fall about 0.5%, but capital expenditures rose 1.3%, which is also better than expected. And then you had a jump up in consumer confidence also. It jumped up to 108. They're expecting it to come in around 104.5, and that's up from prior 103. We had new home sales jump to 28.8%. The reason that jumped up so high was back in mid-August, we had a little bit of a dip in rates. The market kind of pulled back a little bit, and you had a lot of people jump in there to try to lock in those rates and get their houses there when we had a little bit of a pullback. So the problem we've talked about several times is that right now, good news is bad news for the market because the more good news that comes in, that gives the Fed more free rein to nudge rates up a little bit higher than what investors are currently looking for. Generally it's going to take 3 to 6 months for a lot of this stuff to work through the system. So even though we're seeing some of this economic data coming in pretty good, we still haven't. It's still too good for them to say, hey, I think we're where we need to be. And the other big part about this is we're still seeing the initial jobless claims coming in here around under 225,000. That needs to get up and start pushing closer to 300,000 before they're going to really get anybody's attention. You're just having increases and decreases of 3, 4, 5,000 a week. That's not enough to shake anybody up or catch anybody's attention. But anyway, as far as the technical condition of the market goes right now, it is deteriorating. Again, we saw all the technical indicators fell further into negative territory. The market is overly sold. Jim Cramer this morning mentioned the Market Edge S&P short range oscillator. I think yesterday it ended the day something at 13.6 or minus 13.6. That's the lowest it's been since the start of the pandemic. And generally, when it gets below around 7%, we normally will see especially institutional investors come in to buy that. And you can subscribe to that on our market. If you're a subscriber to Market Edge, you can go into the on the homepage and you can get the daily SRO, buy it right on our website. It's probably something that it gives you a chance to buy something that the institutions are using that the normal investors can't buy. You can't buy that through TD or through Fidelity or anything like that. You've got to come through Market Edge to get that. So that's something you ought to consider putting in your arsenal for future use. Okay, like I mentioned last week, we did see the VIX cross 32. I think it was on Friday when we were down big. But then it came all the way back down again to 29.92 is where it ended up. Yesterday we got back up above 30 finally. But that's not a level that you want to see for a market bottom. And what I mean by that, that's the volatility index. And generally you're going to see that thing push up near 40 when you're close to putting in a bottom. You might see it spike one day. I mean, you could see it spike up to like 70 or 80, but we haven't seen anything close to that. I think in June we got down to around 38 or 40. You want to see that, watch that VIX on an intraday basis, or at the end of the day, be pushing 40 just to know that you're okay. Well, now we're getting to the point where things are getting a little iffy here. We want to see what we're doing right now. As I speak, we're 33.17. We're up 91 cents. But again, we want to see that get a kick up to 38, 39, 40, even 45. I always considered a place where I could jump in if the market was selling off, and probably I'm at or real close to the bottom. Defensive sectors outperformed last week, as I mentioned. That was healthcare, consumer staples, and utilities, but they were all lower. And essentially we had, I think communication services, financials, industrials, technology, materials, and REITs. They were essentially at 52-week lows last week. So they're confirming that we're in a bear market. The Dow ended up yesterday at minus 20.5%, I believe. So it's officially in a bear market now. It was kind of holding up a little bit better than the other indexes. As far as underlying breadth goes, it's pretty weak. I mean, you have the NYSE and NASDAQ advanced decline lines. They took out the June lows by a good number. You're talking we had like 5,000 or 6,000. They lost. I think the NASDAQ lost 7,000 units last week on the AD line. We also had new 52-week lows expand to the point where we're at minus 1,000. I think 2 days in a row, Friday and Monday, we had over 1,000 issues. We're making new 52-week lows. Today we're in the 830s. It's just pretty volatile because I'm also seeing today that some of the indexes are, after being down a couple hundred, now we're starting to pick it up here going into the last hour trading. So that's something you want to look at. We also have, as far as investor sentiment going right now, you're overly bearish. We're getting to the part now where we're getting extreme levels again. The retail investor, according to the American Association of Individual Investors survey, it shows that more than 60% of retail investors are bearish. That's only the fourth time in history that retail investors were that bearish. Last time was at the bottom of the financial crisis back in 2009. And then even the hedge funds, National Association of Active Investment Managers exposure index fell to 29.6%. These guys are they're shying away from being open to the market. Also, they don't see enough stuff going on here yet where we're gonna try have a good bounce. I wrote it for the targets. What we looked at, we have our Market Edge ways that we look at targets through some different retracements, Fibonacci retracements. We also look at variable trend lines, that type of thing, and forward lines of demarcation. And what we have right now for the Dow Jones, our target is 27.9. So we probably have from the earlier today we hit 10. Let's see, we got down to 28. So you get down to 27. We got down to 28.9 990 or something like that. So we're getting close. I think we probably could see maybe another 1,000 point drop on the Dow from today's lows. As far as the S&P 500 target goes, it's 3528. Then that would be followed by the 50% retracement from the March 2020 lows to the January 22 highs. That would be somewhere around 3490 to 3500. Today we were at 3650, so we actually were a little bit lower than that earlier today. So we probably have another 100 points to go on the S&P 500. The Nasdaq's already retraced more than 50% of its rally off of from the March 20s, and it actually we're looking at somewhere around 10,650, and that would be about 200 points below where we are with that right now. So it's probably not the best time to be. A lot of times we say maybe you want to nibble away at some of these stocks that you like. You can put some areas of support, maybe a nibble a little bit. I mean, when you're down, I think the Nasdaq may be down almost 30% now. It's not going to kill you to be picking up some Microsoft or some of these big cap tech stocks that have just gotten crushed that you may want to own going forward. I certainly wouldn't be jumping in with both feet. And any type of rally like what you saw this morning, where you're up 350 on the Dow, you don't chase that. If anything, at that point, maybe you look to sell some premium on some covered calls, that type of thing. Or maybe if you decide to jump in and buy something that when you thought a month ago that was maybe a good deal, it's oversold, you maybe had a chance to make some money, but now you're maybe just around even on one of these big jumps. You maybe go ahead and just say, hey, I'll take a small loss here, and we'll wait to jump in a little bit later. But anyway, right now, again, we're back to that good news is bad news, and let's just see how things go. We got earnings coming out here in about week and a half, 10 days. We haven't seen a lot of downgrades as far as estimates go yet. I think starting, if not towards the end of this week, beginning of next week, we'll start seeing more people cut earnings estimates. And then as the earnings start to come in, if they're, then we'll be looking to see what they say for the guiding forecast for the fourth quarter. But I can't imagine anybody coming out and saying, hey, business looks great, and we're gonna up our forward guidance and raise our earnings estimates. I think they'll be pretty conservative, especially with more rate hikes coming. So at this point, just one of these times we just kind of hold on to what you got, and just hope we don't have much further to the downside to go.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.